Many experts believe that the US is currently in a recession, but some also say that this is not true, and that what we're currently experiencing is a mere slowdown. One of these people is Jurrien Timmer, Director of the Global Macro for Fidelity Investments, a multinational financial services corporation with nearly $5 trillion worth of assets under its management. In a recent interview with Raoul Pal, Jurrien Timmer gives his thoughts on the current economic climate in the US, specifically the hot topic of a recession. Thank you for your continued support for the channel. Let's dive right into the video.
Market's gone down 25% to the recent lows. That can all be perfectly explained by valuation and what valuations should have done when the liquidity tide goes from in to out, which of course it has done in a very rapid way. And you can explain that all almost to the decimal point in terms of what that means for the valuation in the stock market here. And so, but a valuation reset and a full recession bear are two different things. And you know this because you've been actually very prescient in calling for this for the last few months. But a typical bear market's 33% over 19 months. A typical recession bear is about 35%. A typical non-recession bear, which is by definition only a valuation reset, is 22%. So we've done 25, we've done it over 6 months. And if earnings are not the next shoe to drop, then we're good to go. There may not be a catalyst for a monster rally, because then for that to happen, you would need PEs to go up. But if earnings end up being the dog that does not bite, then I think the market is on pretty solid footing here. But if we're about to have an earnings contraction, which of course would be part of a recession scenario, then we're not done yet.
In this first clip, Jurrien Timmer points out the main difference between a normal bear market, a recession bear, and a non-recession bear market. A normal bear market is usually 33% over 19 months. A recession bear is normally 35%, while a non-recession bear or a valuation reset is about 22%. Today's market has so far only been 25% according to Jurrien Timmer. He adds that although there may not be a possibility of a huge rally, as long as earnings do not contract severely, the market has a bright future. However, if it does contract, then we might be in a recession bear market, which will be severely problematic for the US economy and for regular consumers like you and I. In this next clip, Jurrien Timmer briefly discusses a contraction in earnings and the sectors that have benefited from this downturn. In this next clip, Jurrien talks about earnings contraction.
Have you broken down the sectors somewhat, not at super granular level, but once you see kind of energy and some of the others, their earnings obviously are holding up because this is a good environment for them, and technology seems to have maybe priced in a recession more so. I mean, I look at a very simple perspective is the year-on-year rate of change of, let's say, the Nasdaq and the S&P. You can see in the Nasdaq it's pretty much priced in ISM at 42, so it's kind of fully there already, or very close. Yeah. What are your thoughts?
Yeah, no, I agree, and it's interesting. Energy is such a small sector. It's not as small as it used to be, but it's a lot smaller than it was in the 80s, for instance. When you look at the consensus earnings estimates for the market, they're like eerily quiet. They're at 4% growth for the second quarter, which we're just starting to report now. But you strip out that little tiny energy sector and you're down to -4%. So earnings are already starting to contract. But the big tech or the big growers, the long duration stocks, were obviously caught in the crosshairs of this rate reset. I mean, 10-year yields like a 1% a year ago or something like that, and it's 3% today. Real rates went from -2 to +1 in pretty rapid order. The long duration stocks, which by definition means discounting a long stream of earnings, those are very sensitive to changes in the discount rate or the cost of capital. And so they fell hard, as you would expect them to when interest rates rise rapidly. But But now interest rates, I think, have peaked for the cycle. The terminal rate has gone from 4% to about 3.5%, and the relative performance of the large growers to the S&P or to small value, if you want to make an extreme pair trade out of it, is very highly correlated to changes in interest rates. And so, the leaders during this downturn have, of course, been the defensive names, utilities, consumer staples. But, the staples are starting to get hit by the strong dollar because they're very sensitive to currency moves. And utilities have gotten kind of expensive. So I think the leadership actually is returning to the big growers here. And as you said, they've already discounted a lot of bad news.
Jurrien Timmer says that in the second quarter of this year, earnings are already beginning to contract. But it has not been as obvious as this contraction has been overshadowed by the profits of the energy sector. Most tech companies have also been hurt due to the rising of interest rates, which have contributed to the contraction of earnings. He further adds that those who have earned the most from this downturn are the utilities and consumer staples sectors. Jurrien Timmer concludes by saying that utilities have been hurt by the rising of the dollar, so he believes that tech stocks or big growers can once again lead. In this next clip, Jurrien further discusses earnings contraction and whether or not the US is in a recession.
What is your hunch here? Do you think that we do take down earnings? Now, they're coming down already, as you said, it's kind of being hidden by the energy sector. Do we take down earnings further so we get to the 33, 35%, and we're kind of there for price? And again, I use the year-on-year rate of change. That would bring us down to, versus the ISM, would bring us down to the low 40s, maybe just below that. Is that the most likely outcome to you, i.e. we've got another leg lower? Or do you feel like, you know what, maybe we can... It seems difficult to avoid a recession, but I don't know, what do you think? It's tricky, it feels tricky here, right?
Yeah, it's a
because
very...
I share your longer term view, but it's this little kind of 3-month window that's difficult.
Yeah, it's a very tricky question because you look at the headline economic data, obviously the ISM has rolled over, but that does, you need to get into the high 40s, as you know, on the PMI to be consistent with negative GDP growth. And of course, we do have negative GDP growth, but it's not really a consumer-led negative GDP growth, right? It's inventories, exports, it's stuff like that. And then you look at the payroll number, we're still printing a few 100,000 a month. Hard to, and I look at the TSA data, 2.4 million passengers a day. Consumers don't seem to have gotten the memo that a recession is imminent. But again, maybe they're the last to know, right? Because they're not going to stop spending until the jobs start disappearing. And we already see, news that companies are not hiring as much, but they're not really laying off in droves either. So I do think it's premature to say that certainly that we're in a recession. I think clearly I shouldn't say clearly, but my guess is that we're not in a recession other than the technical definition of how GDP is constructed. But, the consumer is 70% of the economy. So if the consumer is employed, spending, still has some savings left from the pandemic, it's hard to see, it's hard for me to connect the dots to an imminent recession or certainly one that's already happening. But clearly the cycle is slowing. There's no question about that. But the cycle always goes through a phase where it's slowing. Clearly earnings growth is slowing. It was 50% growth rate 6 months ago. It's about 15% now, probably on its way to 5 or maybe even less. When I look at the internal numbers, so when I look through the consensus estimates and I look at the breadth of the number of S&P 500 companies that are seeing their earnings estimate go up versus down, we've gone from 90% a year ago to now 40%. But even that 40% is not necessarily a recession level. You just, you can lower earnings estimates, but still be positive on a year-over-year basis, right? If that makes sense. So I'm not at all ready to ring the bell on a recession, but clearly we're in an advanced late cycle phase of the market and the economic cycle. And clearly things are slowing. Just consumer disposable income is being eroded by inflation. Companies are going to have a tougher time passing on their higher input costs. It's interesting. in full-on plan. I run a theme camp at Burning Man, not to completely change topics here, but Burning Man's in about 4 or 5 weeks from now. And as the TCO, as the theme camp organizer, I'm in heavy planning mode. And the economy remains very resource constrained, trying to find people to help, move stuff in Reno, securing propane, like stuff like that. So there are still a lot of problems in the economy in terms of bottlenecks and resource constraints. So I think, whenever the next recession comes, and eventually it will, of course, maybe some of that will get resolved, but we're not there. Like, to me, it still feels like a pretty tight economy.
In this clip, Raoul Pal asked for Jurrien Timmer's point of view on the contraction of earnings and what this might lead to. According to Jurrien, the situation is quite complicated, but it all boils down to consumer sentiment. He adds that the negative GDP growth of the US is mostly due to supply line issues and not due to consumers. In fact, consumers continue to travel according to TSA data that Jurrien Timmer was able to acquire. He says that consumers continue to spend money despite the forthcoming recession, and he believes that they may not be aware of this recession, nor will they care until their jobs start disappearing. Jurrien Timmer also clarifies that most companies are not necessarily laying off labor force, but they are stopping their hiring endeavors. He adds that the consumer accounts for 70% of the economy, and as long as they are happy and spending money, it is difficult to say that the US is in a recession. Jurrien also notes a slowdown in earnings growth, which he believes will go down from 50% to 5% year over year. Jurrien Timmer concludes by saying that he is not ready to say that the US is in a recession, but he does admit that there is currently an economic slowdown, mostly due to inflation and supply line issues that have led to a lack of resources. In this interview with Jurrien Timmer, he mainly discusses earnings contractions in a recession in the US. He says that despite the signs of a forthcoming recession, consumer sentiment remains positive and there is a steady flow of money being spent in the economy. Additionally, he is not quite certain that the US economy is in a recession, because yet again, money continues to flow within the economy due to the positive consumer sentiment. He does, however, confirm that the economy is experiencing a slowdown mainly due to supply line issues and sky-high inflation. What did you think of Jurrien Timmer's point of view on the current economic climate? Do you think the US is in a recession, or at least heading for one? Give us your insights in the comment section down below. If you enjoyed this video, give us a like and subscribe. And we'll catch you on the next one.